What I'd like to do is walk you through a presentation so you understand what's going on in the space, why I think it's a table pounding buy here. I've been, as I mentioned, investing in this group since 1985, and I don't remember a time where the fundamentals were so strong and the valuation so cheap. There's a lot of opportunities. You have to know what you're doing. It's easy for individual investors to lose a lot of money in this sector because they don't understand how these stocks work all that well. There's a lot of binary events where stocks can go up in a very significant manner or they can go down to zero. So I'm going to walk you through kind of a framework for how to invest in the sector. But first of all, I want to take you through the overall fundamentals of the group currently. As I said, I really like the sector now. At PVG Asset Management, I can invest money anywhere. I see this sector being one of the most interesting sectors of all sectors out there. Why is it timely? Okay, from February of 2020 through the bottom of 2022, the sector dropped 65%. That's a historical bear market. I want to show you a slide here. This is February of 2020. Here's the bottom of June 2022. It's come up off the bottom a little bit, but not a great deal. And look at the performance versus the S&P 500 over time. Clearly, this is a sector that's got great long-term fundamentals, and it's giving you a great buying opportunity. Valuations. So this is what's so compelling about the sector, is the valuations look very attractive. At the same time, the fundamentals look really, really attractive. You can buy phase 3 assets, and I will explain to you what that means later, but phase 3 drugs of these companies, phase 3 companies that are in phase 1 or phase 2 and have significant cash, maybe some of them trade below the cash on their balance sheet. So you're getting in well below what the smart money got in at. Keep in mind, drug companies are flush with cash. Their pipelines are kind of running dry a little bit. 2025, most drug companies will be kind of in a tough position, needing new products. And there's a lot of potential acquisitions of great drugs out there that are percolating up in these small companies. Keep in mind, healthcare is a growth sector, and biotech is the fastest growing area of life sciences. The science, from when I started investing in 1985, is so much more improved. And I'll talk a little bit more about that in detail. Approvals are much more predictable and are quicker. Computer science is now percolating into this industry, making time to approval much quicker. There was a drug that was approved from one of the stocks that we own that was approved in under 4 years and 3.5 years. It used to take 10 years to get drugs developed and approved on the market. So this is a much higher rate of returns for biotech investors as this has accelerated over time. Now, why is the sector down so much? One, it's because of the market related. But secondly, there were so many IPOs in 2020. There were a record 77 IPOs in 2020. And then in 2021, there were 96. There were hardly any IPOs in 2022. So these companies that should not have been brought public are fading away, are being consolidated, but the good companies are thriving and moving forward. So what's the sector done over time? And it has been pretty incredible. From the start in 1993, the group's up massively, 12 times your money over that period of time. If you look at some spots here, you look back at 2011 or 12, you can see from that point to the high of the market, you had more than 5 times return on your money. And then, as you can see, there's been these consolidations. This is when the market fell by over 50%. And again, it's down 65% over the last couple of years. And after these major declines, you've always had a very significant rebound occur, and you've smoked the S&P 500. Now keep this in mind. These are indexes. If you hire somebody or you are good at picking stocks, you can make a lot more than this, than just the index over time. And I'm going to explain to you what to look for. Major breakthroughs in biotechnology. As I mentioned, the science is so much better. The mapping of the genome occurred in 2003. It's really helped greatly. It's allowed the drug developers, for instance, to know the biomarkers in science, what to attack. A really interesting trend that's occurring in the biotech space is the integration of computer sciences in developing new drugs. Artificial intelligence. What that does, it allows the drug company to look at all the data out there and develop their drug much quicker and get approval much quicker. So as I mentioned, there was a company that got approval in 3.5 years. Generally takes 10. It's really accelerated the approval process. And what's happening because of that, it increases the returns, so it requires less capital to develop that drug for the investors. The biotechnology space is really inefficient, meaning that news flow isn't very quick. There aren't a lot of analysts that cover all these individual stocks. There are over 700 stocks that are in that emerging healthcare space, so biotechnology space. This Axome is an example of that, a really good example. This is a company that I invested in at about $1 a share before they went public in a hedge fund I managed. It went public at 9, so 9 times my money, pretty good, right? Then I sold it and the stock dropped, and then I bought it back. You can see down here is about the low, about $1 or $2 a share. That's where I reinvested in the company. You can see in 2019, this was actually the best performing NASDAQ stock in 2019. It went from that $1 a share up to over $100 per share. So obviously these 100 times returns don't happen very often, and it's because the market is very inefficient. And so you have to do your work. You have to really dig on these companies to find opportunities like this. Knowing this company, we reinvested in it down around here after there was a series of disappointing developments at the company. One of their products got put on hold for a while, so it wasn't approved, and we had a very good view of what was going on. So down in the low 20s, it spiked up to high levels where we kept it, and then came back down. Now today it's back over $75. So this was a 3x return over a less than a 1-year period. So here was 100x. Again, don't expect this to happen very often, and you really have to dig deep on these things. And this is the beauty of this sector. It's really inefficient. Now, this next company, Regeneron, everybody knows Regeneron. It's been around a long time. It's been a great performer, but I wanted to give you another example on how well investing in these type of companies work. So since 2010, nice blue chip biotechnology company, you could have invested in it and gotten a 30x return on this investment. Okay, so the world's getting older and we need more healthcare. It's growing. You can see that healthcare spending over time as a percent of GDP has gone up. So the economy is growing. The amount of healthcare needed is growing. Baby boomers are aging. Lots of people entering the middle class around the world. They want healthcare. In the U.S., we're averaging $12,500 per person I can't think of too many sectors of the market where you spend that kind of money. Here are the number of drugs being approved. And if you go back in time, a little further back, it's much lower. This in 2016, the last year of the Obama administration, for whatever reason, there wasn't very many drugs approved. A new FDA commissioner, lots of drugs being approved. And I mentioned before, the science is much better. That's why more drugs are being approved, in my opinion. So as more drugs are being approved, it means more shots on goal, more returns for biotechnology investors. Now, how to invest. So the sector looks interesting. You have to do your homework. It's very inefficient, meaning if you do your work and understand how to invest in the sector, you can really make big money. Okay, so say you don't want to hire somebody or you can't do it yourself. The ETF XBI is the small cap biotechnology stocks. That was the first graph I showed you earlier. Here's the XBI, great place to invest, but over time, someone like myself should be able to smoke that index. The other area to invest is the large cap companies, where you have companies like Amgen and Biogen and Regeneron, more conservative, lower returns. Yeah, in my opinion, less exciting. So what I like to do, I like to think about two ways of doing it. I can invest in a portfolio of 25 stocks. And in these 25 stocks, you can get companies that have, in general, for the whole 25, have 3 to 5x upside. So meaning if you own it for, say, 5 years, you're likely to get maybe close to a 5x return. Now, if you're even more ambitious and you want to concentrate your bets, I like to, you can get 5 to 10x returns over that same period of time by investing in 10 stocks. Obviously, this is much more risky and it's much more aggressive. You're not going to always hit them out of the park. You're going to have some disappointments along the way, but the returns are better if you pick the right companies. How I look at it is that you can invest in the indexes, or you can hire somebody or do the work yourself and pick the best 10 companies you can come up with, or the best 25 companies that are out there. And I want to walk you through kind of this a little bit. Before I go on, I want to mention that if you're in a managed account by somebody, say like myself, if you're in a managed account, you can have the manager limit the downside in a bear market by putting a hedge in place, so you don't have the 65% drawdowns, and you can tax harvest your losses, so your capital gains at the end of, say, every year or a 5-year period are much lower than they would be just investing in an index. So here's how it works. So when a company is in phase 1, you get a modest valuation. If you're preclinical, it's a long shot. Your valuation of that company is very low. If you're phase 1, meaning you are evaluating if the drug is safe or not. So this is your safety study. You generally get a valuation of something 25 million or lower. And then if you make it through phase 1 and you move on to phase 2, you get a higher valuation. If you survive phase 2 and your data looks good, then the stock price goes up. So in phase 2, proof of concept, it works. You're going to get maybe a $100 million valuation or more. And then phase 3, now this is where all the fun really begins. This is where you can get really big returns. If you hit it on phase 3 and your data is good and it's in an area of unmet medical need, I've seen quite often on phase 3 data, stocks go up 200 to 500% overnight. Now, what's the probabilities of success in different areas and different phases? This is probably one of the more interesting slides I'm going to show you. In phase 1, your probability of success to get to phase 2 in oncology, which is a tough area, is less than 50% success rate. So that drug has a coin flip shot of working, of being successful, to getting just to phase 2. Phase 2 to phase 3 in cancer, again, not very good, very low. And if you complete phase 3 in cancer, your odds of success, even from that point, are not that great. They're less than 50%. So if you file for approval in cancer, meaning the company thinks it's going to work, the FDA basically allows you to make that filing, says, okay, here's what we need, what we expect you to prove out on your phase 3 to be able to file that drug. And if you've done so, you have a really high probability of success, 92%. So if you think about this, you want to buy phase 3 assets. The later the stage, the better. If they've already proven the drug and filed for drug approval, you got a high probability of winning in all biotech. Right now, okay, right now, these drugs, phase 3, are trading as if they were phase 2 and sometimes phase 1 assets. And I'm going to show you a few before we wrap up. Just keep in mind, drugs down here in phase 1 to approval is very low. So watch what you buy. If someone tells you this is the greatest thing ever and it's in phase 1, just keep in mind the odds of it working, of you actually making money on it, are pretty darn low. Now, stock selection. This is what I do as an investor. I've got to look at everything. I just can't look at 1 or 2 stocks and have a good feel for everything. I got to look at all 700 stocks out there. And I do it quantitatively. I do it in the computer. We track all the pipelines of all these companies, their valuations, how much cash they have. And so you can say, okay, I've got a phase 3 asset. They've got plenty of cash to get to approval or beyond, and the drug looks very promising. That will hit our screens to say, okay, that's one we want to take a closer look at. And so what we do is we narrow all these 700 stocks down, we talk to management, and then we come up with a portfolio, as I mentioned before, 10 to 25 stocks that have anywhere between 3 times upside potential for each stock to 10 times upside potential or more, like the Axome that I showed you previously. Investment focus. So I like to think of the industries that I want to invest in where I see opportunities. And cancer, there's so many opportunities in cancer. It's something that will be cured over time, but we're not there yet. And there's a lot of really interesting things in cancer. We're on our 2nd generation now of really good immunotherapy drugs, and the success rate to save patients is really going up greatly. And the industry is very large, so there's a lot of money being spent on cancer. If you have a good drug in cancer and it's approved, that company's going to make a lot of money. The investors are going to do really well on it. Alzheimer's. It's such an unmet medical need. I don't particularly like the Biogen drug, although it looks like the second one works. It could be a 5 to maybe a $10 billion drug, but there's better drugs out there. Some companies are private, and that'll go public hopefully next year. But this is a real focus for me in finding really interesting ideas. And this is the biggest unmet medical need out there, and it's going to be huge over time. The science is so much better than what it was before. Cardiology, this is the leading cause of death in the U.S. There really aren't that many drugs out there for cardio. The issue with this is there are some really good drugs being developed by small biotechnology companies, and the large drug companies, they don't have the pipeline. You know, the pipeline's in with all the other small biotechnology companies, And when there's a drug that works, it's snapped up very quickly. So this is a good opportunity for us as well. NASH. You're wondering, what is NASH? Non-alcoholic liver disease. It's a very large area of the market. People don't understand how big NASH is. And ultimately, if you have NASH, it progresses over time. You die, or you have to get a liver transplant if you're lucky. So there looks like there is a company that's going to get approval, and I'll talk about that. We like this particular company here, Viking. We think it's the best play in the NASH space, but there's a larger company that just announced phase 3 data, and the stock shot up greatly. In a 4-day period, it was up 5 times the money. Rare diseases. This is something that most investors aren't aware of, but there are a total of 5,000 rare diseases. Now, rare disease is a disease where there's less than 2,000 patients. And you've probably heard of these drugs out there that cost you $150,000, $200,000. And the FDA allows this to happen because there's no other cure for it. There's nothing to treat these rare diseases. So a lot of companies are focused on this area. They get approved quicker. There's better patent life. And again, I've seen it happen over and over again where a stock's trading at $1. They hit their marks on the rare disease, and all of a sudden it's $10 a share. Here are some of the companies we like. Now, I'll give you the ticker symbols of these companies. GTHX and ALRN. These are both cancer drugs that protect against the side effects of chemotherapy. If you think about that, isn't that something that's really interesting? The more chemotherapy you can apply to a patient, the higher probability of success for that patient of eliminating the cancer. BTAI, this is the artificial intelligence company I've told you about earlier. Developed a drug in 3.5 years. The reason I like it is for their next drug. It's for agitation in Alzheimer's disease. If you haven't experienced or seen agitation in Alzheimer's disease, it's not pleasant. The patient is very difficult to deal with. There are 100 million of these episodes occurring in the US every year. It is a very large area for revenue potential. I like this company a lot. I think there's a lot of near-term upside. They will release their top-line results in the first half of 2023. I expect they're going to look pretty good, as that same drug was already approved for a slightly different indication. Now, the cardio space. I got two here that are very sound investments, and a third that I think it's a long shot, but could be a big winner. So all three companies have very good products. This one here, SCPH, has already been approved. It's on the market. The market cap's low. MIST is something that just released phase 3 results, and it'll go up significantly over time as well. Wintree Therapeutics, WINT. Now, one of the risks of investing in this space is, even though you may have a good drug, you may run out of money. So if you run out of money, Wall Street will punish you like you would not believe. So this stock was much higher, maybe $10 a share. It's currently less than 20 cents a share. They had really good phase 2 data. So if you remember, phase 2 data is not a home run, but it's a really interesting science. Looks to me like it's going to be approved. Hopefully the company can raise some money. If not, my guess is somebody buys them out at 2 to 3 times where the stock's trading. But this has big potential over time. Viking, VKTX. This is my pick in the NASH space. Remember, NASH is very large. There's no drugs approved. This is similar to a company, MDGL. This is the company that just released phase 3 data and the stock went up 5-fold. Well, Viking is a couple years behind them, but looks like they have a better drug. Oh, here's another good one. This is in the rare disease space. Okay, SYBX. I always look for who's investing in this company, who was the smart money, who put the money down for the opportunity to see this company succeed. This company here has got some great investors in it. It trades for 70 cents a share. Again, 10x return potential or 100x return potential. It's big. This is a drug that hits a disease. It's a small area of the market. They'll get a really nice price for that drug when it's approved. So this is our pick in the rare disease space. And then last but not least, Checkpoint Therapeutics. Checkpoint is a drug that is similar to Merck's Keytruda. It's a immunotherapy drug. It's the first generation type of drug. There are other companies that are developing second generation products. This is a good drug in that it has higher efficacy than the Merck drug and all the rest of the other drugs in the space. There are 5 approved drugs in this area, and this area is a large area of the oncology drug space. It's probably doing 25 to 30 billion dollars a year in revenues. And Checkpoint has the best efficacy of all the drugs out there. They announced their phase 3 data. They will file for approval here in the first part of 2023 and hopefully be on the market in 2024. Again, major screw up by management. Major screw up. They ran out of money. Big mistake. Okay, so they've had to raise money recently at roughly 60 cents a share. The stock was $4 when they released their data. They ran out of money, 60 cents. So this is a phase 3 filing their NDA, high probability of success drug, trading like it's a phase 1. So this one has 5 to 10x return potential. Highly likely it's going to get approved. As you know, we think there's some great opportunities in the biotechnology space. Please hit like and subscribe, and we'll send you our next update. Take care.